The global silver market delivered one of the most aggressive overnight moves witnessed in recent years, yet the financial media barely acknowledged the scale of what had just occurred. Because while mainstream investors remained distracted by equity headlines, central bank commentary, and the latest technology rally, silver quietly surged nearly 12% in an explosive repricing event that revealed something far deeper beneath the surface of the global monetary system. A system that institutional desks, commodity traders, sovereign buyers, and experienced macroeconomic analysts immediately recognized as entering a potentially dangerous transition phase, where confidence in monetary authorities, sovereign debt stability, and the sustainability of global liquidity conditions began weakening simultaneously, creating a powerful environment for hard assets to reprice rapidly, especially assets like silver that hold both monetary and industrial importance. Because, unlike gold, silver functions not only as a hedge against inflation and currency debasement, but also as a critical industrial component required for electronics, military systems, solar infrastructure, semiconductors, medical technologies, electric vehicles, and emerging artificial intelligence hardware, which means that during periods where monetary distrust collides with rising industrial demand, silver often becomes one of the few assets capable of benefiting from multiple global trends at the same time. That exact dynamic appeared to unfold during the overnight session, as futures exchanges across multiple regions experienced unusually aggressive institutional buying pressure, characterized by large contract sizes, synchronized accumulation patterns, and heavy volume spikes that strongly suggested participation from major commodity funds, sovereign wealth entities, commercial hedgers, and potentially central bank-linked institutions positioning themselves ahead of tightening physical supply conditions, while at the same time, mainstream financial coverage remained remarkably muted, despite the fact that a double-digit overnight move in a major commodity would normally dominate financial headlines across every major investment network, a silence that many commodity specialists interpreted not as irrelevance, but as evidence that the broader financial establishment remains uncomfortable, discussing the implications of rapidly rising precious metals prices, because a powerful silver rally often signals deteriorating trust in fiat systems, rising inflationary expectations, mounting concern regarding sovereign debt sustainability, and growing recognition that central banks may no longer possess the same degree of control over economic stability that investors assumed throughout previous decades, particularly as governments around the world continue struggling with exploding deficits, rising debt servicing costs, slowing productivity growth, weakening consumer demand, geopolitical fragmentation, unstable bond markets, and increasing pressure to maintain economic activity through additional liquidity injections that further erode confidence in long-term currency purchasing power, all while physical silver inventories continue tightening globally as bullion dealers across North America, Europe, and Asia report shrinking wholesale supply, expanding premiums above spot pricing, longer delivery delays, and growing demand from both institutional and private buyers seeking direct ownership of tangible assets outside the traditional banking system, creating conditions that many experienced commodity traders compared to previous silver squeeze environments where leveraged paper exposure collided with restricted physical availability and forced large commercial short positions into increasingly unstable territory, because the silver derivatives market contains enormous leverage relative to available deliverable inventories, meaning that when aggressive buying pressure enters the market, short covering cascades can rapidly accelerate upward momentum as traders rushing to exit losing positions effectively become additional buyers themselves, reinforcing price appreciation and creating violent repricing events similar to those witnessed during the 1979-1980 silver explosion, the 2011 rally toward $50, and multiple historical commodity squeezes that emerged during periods of monetary instability, supply stress, and institutional repositioning, while today's macroeconomic environment arguably contains even stronger bullish ingredients than previous cycles due to record global debt levels, fragile banking systems, structurally rising inflationary costs, deglobalization pressures, constrained mining supply growth, expanding industrial consumption requirements, and increasing skepticism surrounding the ability of central banks to stabilize financial markets without eventually returning to aggressive monetary expansion policies that historically benefit scarce tangible assets like silver. What makes the current silver environment especially significant is the growing structural imbalance between expanding industrial demand and increasingly constrained supply dynamics, because unlike previous decades, where silver demand was driven primarily by jewelry consumption, investment speculation, or monetary hedging activity, the modern global economy now depends heavily upon silver for the construction of renewable energy systems, electric vehicle production, advanced computing infrastructure, semiconductor manufacturing, telecommunications equipment, military applications, medical technologies, and artificial intelligence hardware expansion, all of which require substantial and continuous access to highly conductive materials that few alternatives can adequately replace at scale, causing silver to evolve into one of the most strategically important commodities within the modern industrial landscape, while simultaneously remaining a precious metal traditionally associated with monetary protection during periods of inflation, currency weakness, or sovereign instability, thereby creating a uniquely powerful dual demand structure that very few other assets possess. Because whenever financial uncertainty begins rising at the same time industrial consumption accelerates, silver becomes capable of experiencing explosive price appreciation driven by both defensive capital flows and real-world manufacturing necessity. Yet, despite this increasingly obvious strategic importance, global silver supply growth remains severely constrained due to the structure of the mining industry itself, where most silver production originates not from dedicated silver mines, but as a byproduct of copper, lead, zinc, and gold extraction operations, meaning that even dramatic increases in silver prices do not automatically translate into rapid production expansion, since mining companies require years to secure financing, obtain environmental approvals, develop infrastructure, construct facilities, and scale operational output, a process made even more difficult by rising geopolitical tension, energy costs, labor shortages, environmental restrictions, and fragmented supply chains that continue disrupting global resource development, while above-ground silver inventories quietly decline as sovereign entities, institutional investors, industrial users, and private wealth holders increasingly remove physical metal from liquid circulation and store it inside long-term vaulting systems, strategic reserves, or manufacturing stockpiles, where it becomes largely unavailable for immediate market delivery, intensifying concerns surrounding the widening disconnect between enormous paper-silver trading volumes and the comparatively limited quantity of physical silver actually accessible within exchange inventories, because under normal conditions, most futures contracts settle financially without requiring physical delivery, allowing the highly leveraged derivatives structure to function without major disruption. But during periods of rising distrust, supply anxiety, or aggressive institutional accumulation, delivery requests can increase rapidly and expose vulnerabilities inside the paper-to-physical ratio, potentially creating a scenario where too many market participants attempt to claim ownership over the same underlying ounces simultaneously, a risk that many experienced commodity specialists believe is already beginning to emerge beneath the surface as institutional buying accelerates and physical availability tightens across multiple regions, while geopolitical fragmentation further compounds these pressures, because governments increasingly recognize that control over strategic resources represents a critical component of economic resilience and national security in a world characterized by deglobalization, trade disputes, sanctions, military competition, and industrial reshoring efforts, leading major powers to secure access to essential commodities like silver through quiet accumulation programs that often remain undisclosed until after substantial positioning has already occurred, especially given that public acknowledgement of large-scale sovereign silver purchasing could itself trigger additional market demand and accelerate prices higher before stockpiling objectives are completed, all while global fiscal conditions continue deteriorating as nations struggle with expanding deficits, unstable bond markets, aging populations, slowing economic growth, and debt burdens that appear mathematically impossible to stabilize without either severe recessionary contraction or inflationary monetary expansion, circumstances that historically create highly favorable conditions for precious metals, because investors begin questioning whether fiat currencies can preserve long-term purchasing power under such policy trajectories, thereby encouraging capital migration towards scarce tangible assets with no direct counterparty risk. And since silver remains a comparatively small market relative to the scale of global institutional capital, even modest reallocations from pension funds, sovereign wealth vehicles, hedge funds, or commercial entities could produce disproportionately large price movements capable of overwhelming available supply and forcing rapid repricing events that exceed conventional valuation expectations. Perhaps the most important aspect of silver's overnight 12% explosion is that the rally may represent the early stages of a much larger systemic transition rather than a temporary speculative anomaly, because financial history repeatedly demonstrates that major asset revaluations often begin quietly beneath the surface of broader markets before eventually accelerating into powerful mainstream trends. Once institutional conviction strengthens and retail participation finally arrives, a process that appears increasingly visible today as the global economy enters a period characterized by weakening confidence in monetary authorities, rising sovereign debt instability, persistent inflationary pressure, geopolitical fragmentation, fragile banking systems, and growing recognition that central banks face an increasingly impossible dilemma where maintaining restrictive monetary conditions risks severe recession and financial instability while reversing toward aggressive easing, threatens renewed currency debasement and declining trust in fiat purchasing power. Both outcomes historically favorable for precious metals and especially supportive for silver due to its combination of monetary and industrial demand drivers, because unlike purely financial assets that depend heavily upon perpetual liquidity expansion and investor optimism, physical silver embodies tangible scarcity that cannot be digitally created through central bank policy decisions, requiring years of mining development, refining capacity expansion, infrastructure investment, and geopolitical cooperation to meaningfully increase supply, all while industrial consumption continues rising due to accelerating technological adoption and strategic infrastructure requirements across energy, defense, electronics, and computing sectors, causing sophisticated investors to increasingly view silver not merely as a speculative commodity, but as a strategically important asset positioned to benefit from multiple converging macroeconomic trends simultaneously, including inflation hedging, currency protection, industrial growth, geopolitical resource competition, and institutional diversification away from overvalued traditional financial markets. Particularly given that most major portfolios remain heavily concentrated in equities, bonds, and technology-driven growth assets after decades of liquidity-fueled expansion, leaving precious metals exposure historically low relative to previous monetary transition periods, and creating the possibility that even relatively small reallocations into silver could generate outsized price effects due to the market's limited size and restricted liquidity profile compared to the vast quantities of global capital currently seeking stable long-term stores of value, while the psychological structure of silver bull markets further supports the idea that the current environment may still represent an early-stage transition rather than a mature speculative peak. Because historically, silver rallies tend to unfold in distinct phases beginning with quiet institutional accumulation, largely ignored by mainstream media, followed by broader recognition as prices continue strengthening and supply pressures intensify, and ultimately culminating in widespread retail participation and speculative momentum. Once financial headlines can no longer ignore the scale of the move, a pattern that appears increasingly relevant today, given the unusually subdued media response surrounding such a dramatic overnight surge, despite the clear macroeconomic significance of the event, suggesting that informed capital may already be repositioning ahead of broader public awareness. And if that interpretation proves accurate, the implications extend far beyond the silver market itself, because sustained hard asset outperformance would signal deeper structural stress within the architecture of the global financial system, including declining trust in sovereign debt sustainability, weakening confidence in central bank policy effectiveness, tightening commodity supply chains, and accelerating competition for scarce tangible resources, all of which point toward a world entering a more volatile and inflation-sensitive economic era, where assets tied to real physical scarcity regain strategic importance after decades of relative neglect, making silver's sudden overnight explosion potentially less of an isolated market event and more of an early warning signal that a much larger repricing cycle may already be underway beneath the surface of global finance. The deeper significance behind silver's explosive overnight rally becomes even clearer when examining the broader structural imbalance developing across the global commodity system, because most investors continue viewing silver primarily as a speculative metal or secondary alternative to gold, while institutional analysts increasingly recognize that silver has evolved into one of the most strategically important raw materials within the modern industrial economy due to its unmatched conductivity and critical role in renewable energy systems, electric vehicles, semiconductor manufacturing, artificial intelligence, hardware, telecommunications infrastructure, medical technology, military applications, and advanced computing systems, creating a demand environment fundamentally different from previous decades when silver consumption relied more heavily upon jewelry, photography, or traditional investment demand. And this transformation matters because industrial dependency makes demand destruction far more difficult once entire technological ecosystems require stable silver access to maintain production capacity, meaning manufacturers may continue purchasing silver even at elevated prices, simply because operational shutdowns caused by material shortages would create even larger financial losses. While at the same time, silver maintains its historical identity as a monetary asset capable of attracting defensive capital during periods of inflation, currency weakness, sovereign debt stress, or declining confidence in central bank policy effectiveness, thereby placing silver in a uniquely powerful position where both industrial expansion and monetary instability can drive demand simultaneously, a combination very few other commodities possess, especially during periods of geopolitical fragmentation, deglobalization pressure, and accelerating competition for strategic resources. At the same time, silver supply growth remains structurally constrained due to the nature of the mining industry itself, because the majority of global silver production originates as a byproduct of copper, lead, zinc, and gold extraction, rather than dedicated silver mining operations, meaning that even dramatic increases in silver prices do not automatically generate rapid supply expansion, since mining companies require years to secure financing, complete exploration programs, obtain environmental approvals, build infrastructure, develop refining capacity, and scale operational output, all while rising labor costs, energy prices, regulatory restrictions, and geopolitical instability continue complicating resource development worldwide, causing above-ground silver inventories to tighten as sovereign entities, industrial consumers, institutional investors, and private wealth holders increasingly remove physical metal from liquid circulation and place it into long-term vaults, strategic reserves, or manufacturing stockpiles where it becomes largely inaccessible for immediate market delivery, intensifying concerns surrounding the widening disconnect between enormous paper silver trading volumes and the comparatively limited quantity of deliverable physical supply actually available within exchange inventories. Because, under ordinary market conditions, most futures contracts settle financially without requiring physical delivery, allowing the highly leveraged derivative structure to function smoothly. But during periods of rising distrust or supply anxiety, delivery requests can rise rapidly and expose vulnerabilities inside the paper-to-physical ratio, potentially creating conditions where multiple claims exist against the same underlying ounces simultaneously, a risk many commodity specialists believe is already beginning to emerge beneath the surface as institutional buying pressure accelerates and physical availability tightens across major regions. Another major factor driving institutional interest in silver involves the rapidly deteriorating condition of global fiscal systems, because governments around the world continue facing expanding deficits, rising sovereign debt burdens, unstable bond markets, slowing productivity growth, aging populations, and increasing political pressure to maintain economic activity through additional monetary support measures, circumstances that many experienced investors believe cannot be stabilized indefinitely without either severe recessionary contraction or renewed inflationary liquidity expansion, both of which historically create favorable conditions for precious metals, as capital begins searching for stores of value less dependent upon government credibility or central bank intervention, while silver's comparatively small market size further amplifies its upside potential because even modest reallocations from pension funds, sovereign wealth vehicles, commodity funds, or institutional portfolios could overwhelm available supply and generate disproportionately large price movements relative to larger financial markets, especially considering that silver historically lags gold during the early stages of precious metals bull markets before eventually outperforming aggressively. Once momentum strengthens and broader participation enters the market, a pattern increasingly visible today as institutional accumulation appears to intensify despite relatively limited mainstream media coverage, suggesting that informed capital may already be repositioning ahead of a larger repricing cycle tied not only to industrial demand growth but also to rising concern regarding monetary instability, strategic resource competition, and the long-term sustainability of the current global financial architecture. Perhaps the most important question surrounding silver's explosive overnight rally is whether the market is beginning to reprice an entirely new economic reality, rather than reacting to a temporary speculative event, because financial history repeatedly demonstrates that major asset revaluations often remain unnoticed during their earliest stages before eventually accelerating into powerful mainstream trends. Once institutional conviction strengthens and broader market participation arrives, a process that appears increasingly relevant today as the global economy enters a period characterized by weakening confidence in monetary authorities, rising sovereign debt instability, persistent inflationary pressure, geopolitical fragmentation, fragile banking systems, and growing recognition that central banks face an increasingly difficult dilemma where maintaining restrictive monetary policy for too long risks recession, liquidity stress, and financial instability, while reversing toward aggressive easing threatens renewed currency debasement and declining trust in fiat purchasing power. Both outcomes historically favorable for precious metals, and especially supportive for silver because, unlike purely financial assets dependent upon continuous liquidity expansion and investor optimism, physical silver represents tangible scarcity that cannot be digitally created through monetary policy decisions, requiring years of mining development, refining expansion, infrastructure investment, and geopolitical cooperation to meaningfully increase global supply, all while industrial consumption continues rising due to accelerating demand across renewable energy systems, electric vehicles, semiconductor production, defense technologies, telecommunications, infrastructure, artificial intelligence hardware, and advanced computing applications, causing sophisticated investors to increasingly view silver not merely as a speculative commodity, but as a strategically important asset positioned to benefit simultaneously from industrial growth, monetary uncertainty, geopolitical resource competition, and institutional diversification away from heavily overvalued traditional financial markets. Another critical factor supporting the possibility of a much larger silver repricing cycle involves the extreme concentration of institutional capital within equities, bonds, and technology-driven growth assets after decades of liquidity-fueled expansion, because precious metals exposure across many major portfolios remains historically low relative to previous monetary transition periods, creating conditions where even modest reallocations towards silver could generate disproportionately large price movements due to the market's comparatively limited size and restricted liquidity profile compared to the enormous scale of global pension funds, sovereign wealth vehicles, hedge funds, and institutional investment pools searching for long-term stores of value capable of preserving purchasing power during periods of financial instability, while the historical structure of silver bull markets further reinforces the argument that the current environment may still represent an early-stage transition rather than a mature speculative peak, since silver rallies traditionally unfold in recognizable psychological phases, beginning with quiet institutional accumulation, largely ignored by mainstream media, followed by broader recognition as prices continue strengthening and supply pressures intensify, and ultimately culminating in widespread retail participation and speculative momentum. Once financial headlines can no longer avoid discussing the scale of the move, a pattern that appears increasingly visible today given the remarkably subdued public reaction surrounding such a dramatic overnight surge despite the clear macroeconomic significance of the event, suggesting that informed capital may already be positioning ahead of broader public awareness, particularly as tightening physical inventories, growing delivery concerns, and increasing industrial demand continue exposing vulnerabilities inside the highly leveraged paper-to-physical structure of the silver market, where multiple claims frequently exist against the same underlying ounces. The broader implication behind silver's sudden overnight explosion therefore extends far beyond the precious metals sector itself, because rising demand for hard assets, tightening commodity supply chains, sovereign debt instability, declining trust in monetary management, and accelerating competition for scarce strategic resources all point toward a world entering a far more volatile and inflation-sensitive economic era where tangible assets regain strategic importance after decades of relative neglect, making silver uniquely positioned due to its dual identity as both a monetary hedge and an indispensable industrial material essential for modern technological infrastructure. And if institutional investors increasingly conclude that monetary instability, constrained mining supply, expanding industrial consumption, and geopolitical fragmentation are converging simultaneously, silver could experience a repricing event far larger and faster than most current market participants anticipate, because physical commodity markets historically revalue aggressively once confidence in future supply availability begins deteriorating, especially in markets as comparatively small as silver, where limited liquidity allows institutional capital flows to produce outsized price movements, meaning the overnight 12% rally may ultimately represent not an isolated anomaly, but an early warning signal that a much broader transition is already unfolding beneath the surface of global finance, one in which hard assets tied to real scarcity increasingly outperform financial assets, dependent upon perpetual debt expansion and central bank intervention. And by the time mainstream narratives fully recognize the magnitude of that shift, the most significant phase of silver's repricing cycle may already be well underway.